In today's video, I'm going to be going through bookkeeping basics for small business owners. Now, that is the 3 financial statements that you should be looking at every single month. And we're also going to talk about your accounts payable and accounts receivables, and I'll give you some tips at the end of the video. So let's start with your 3 financial statements. Your 3 financial statements are your cash flow statement, your profit and loss statement, or what you will call your income statement, and your balance sheet. Your cash flow statement is the easy of the 3, and that tells you how money is coming in and out of your business. Your income statement, or what you will also call your profit and loss statement, so that requires your revenue, which is money that you would have collected for the business and also money that you would have paid out. And when you subtract the difference, then you would get either if you made a profit or if you made a loss. Now, that is basically your revenue, which is called your revenue, money that you collected, and the money that you would have paid out would have been your expenses. And then after that, you would either get a profit or you would get a loss once you subtract the 2. So obviously, if your revenue is more than your expenses, you have made a profit. If your expenses is more than your revenue, you would have made a loss. If you're in the beginning stages of your business, if you are in the beginning stages of your business and you are making a loss at this point, that is totally understandable and fine because you're building your business. So don't let those numbers scare you. Keep doing what you're doing and be consistent, persistent, and you will succeed. This is your goal and your dream. Your balance sheet is your assets, your liabilities, and your equity. Assets are what you own, which is your cash, your computer, your table, your chair. Anything that the business owns is an asset. Your inventory that you would have bought is an asset to the business. Liabilities are anything that you owe. So let's say that you pay for the light bill, you pay for the phone that you use for the business. All those things are liabilities, and that's money that you owe out to that company. So those are liabilities because you owe for those. Equity is what belongs to you, the business owner. Because if you owe 100% of the business and you don't have obviously shareholders or anything like that, then all that equity, anything that which is, and how you get out the equity, you take the assets, you subtract it from the liabilities, and you will get your equity amount. And that's how much you know that the business actually owns at the end of the day, right? So when you would have started your business, you would have invested in your business. So that would have come from you. And you would have taken that money and you would have put cash in the business. So let's use cash. You took cash, your personal cash, you put it into the business, right? Now, in accounting, with the 3 of these happening, the assets, the liabilities, and the equity, they are always debits and they are always credits. So basically, when you would have invested money into your business, the equity would be credited and the asset would get debited. Now, in accounting, those 2 credits and debits always have to equal each other. If you are using an accounting system, this does it in the background, so you don't have to worry about it once your books are set up properly. And I do have a video that I would have made on setting up your QuickBooks Online, and you can definitely watch that when this video is finished. So let's make sure that you understand that. Assets are what you own, liabilities are what you owe, and equity is what belongs to you, the business owner. Every single month, you as a business owner, you will either be creating invoices, that goes on to your accounts receivables, because that's when customers come in, they buy stuff from you. That's your accounts receivables. Receivables are what you're getting into the business, which will be your assets. When you receive that money, that's your assets. And your accounts payables is what you will be, when you get those bills from the electricity company or the water company, you will put those bills in your accounting software, and those will be your accounts payables. and that is your liabilities. And then any money that you decide to invest in the business, so let's say you're a single member LLC and you decide, well, I need to put some money into the business to be able to purchase this property, and you put money into the business, now that will be owner's contribution, and that's an equity account, right? Now the tips that I want to give you before I end this video is register your business. Make sure you form an LLC is a limited liability company, and it separates you from the business. So if anything happens and someone has to sue you, and if anything happens with your business and someone sues the business, you are completely separated from that. So I love an LLC. My business is an LLC. My business is an LLC, and I do highly recommend that. I have a friend that, you know, she does help you get LLCs, and if you're interested in getting your LLC, definitely put it in the comment section below and I will link you to her. Her name is Wanda, and she's somewhere on my channel. She's somewhere on my channel called Legal. She works with Legal Shield. Now the next thing is make sure that you have a separate account for your business, be it a business bank account or a personal account, because you want to make sure that you're able to track what's going on in your business separately. You don't want any co-mingling, which means that you are using your personal account, personal, you're dipping into the business account to buy your personal gas and you're swiping your card. No. You don't want to do that. You don't want to mix business with personal, because that would really mess up your books, and that does not look right in the IRS eyes as well. So no co-mingling. As you get an accounting software, so you can record your own books. Set it your accounting software, make sure that's set up properly. Even if that's the one thing that you pay to get done, get your books set up properly from the get-go, so that you don't have to pay out a lot of money in the end. I see this happen with a lot of business owners. You know, you come, you do your own books, you do a bunch of foolishness in those books, then you end up years after, you decide, oh, well, I'm making money now, I want to pay out to get this here started, because, you know, I want to make sure that I'm paying my taxes. And then you go to a bookkeeper and then they charge you this big amount because your books are messed up, you made a mess, and now they have to come clean it up. So you don't want to be in that position. And if you are, I'm so sorry. Maybe you can start to get yourself set up in the right direction. That's it for the video today. If you have any questions, put it in the comment section of this video and I will happily respond to you. Bye.